Well, it's safe to say that many states are in pretty fiscal dire straits thanks to their out-of-control spending and reduced tax revenues. And that may go for the federal government, too. The Federal Reserve trying to soften the blow with trillions in spending the last couple of years. And while some say that quantitative easing, as it is known, has helped, others warn it is creating a risk of another kind, a huge Fed-forced asset bubble. Keith Springer is president of Springer Financial Advisors and joins us now from California. What's wrong with a Fed-inflated asset bubble? Stock market's going up, Keith.
Well, that's what it is. It's just short-term, Brian, and that's all we can count on. What they're trying to do is create artificial demand in an economy where there is no aggregate demand. And so what they're doing is basically creating that demand to spur the economy, which is great. We're getting some asset bubble in inflation on commodities, but not assets in real estate. But we're getting a stock market which is making everybody feel better. But eventually you got to pay the bills, right?
Do you think it's necessarily, though, a bad thing, right? We've got to pay the debt, but at least we are seeing a little asset inflation, and asset inflation, stocks, right, 401k plans, maybe housing at some point. Why is that bad?
Well, it's good on the short term, and in fact, I like what they're doing. Is in fact, if you were a corporation on the verge of bankruptcy, you would borrow as much as you could instead of declaring bankruptcy if you could borrow at zero or next to zero. And that's what the Fed has been allowed to do. As long as rates are low, it's actually a great deal. I would do it, you would do it, anybody would do it. Unfortunately, at some point, someone's going to step in, the bond vigilantes, similar to what happened in Greece and in Europe, and is going to force interest rates higher. And you've got to create serious aggregate demand enough to sustain the economy. And at that point, it needs to be basically live on its own. And it can't do that right now, Brian, because we don't have the aggregate demand. Basically, we've got two headwinds. We've got a demographic situation. We have an aging baby boomer, well past their peak spending years. We know people peak their spending at 48 years old, and you got everybody over leveraged. So at some point, you have to find that equilibrium.
Do you believe, Keith, the Dow is up to where it is today because of the Fed? Do you think the Dow would still be below 10,000 if it wasn't for the Fed?
I do, Brian. I do think it's the market and the economy is essentially addicted to the quantitative easing. I think it's a given that QE2 is going to finish out. I believe that QE3 is actually being built into the stock market, and that's what we're seeing. I think Bernanke is very aware of what happened in 1937 when they raised interest rates prematurely, saw and thought the economy was better than it actually was, raised rates, and we went through another round of depression. And I don't think he's going to allow that to happen.
So what happens when the needle is pulled then? What happens when the Fed, if we are addicted to the Fed, right? What happens when the Fed pulls the medicine, as Bob Dylan called it?
Well, that's what I've been writing about continuously, because when they do pull it, I don't want to be the one left holding the bag. I like the idea. Bubbles are a place for people to make money who are very, very nimble. You can buy certain securities, certain investments, be very careful. I mean, that's exactly what we do for our clients. I like to focus on income, on dividends. You can still find high-yielding investments, things that protect you a little bit when the market declines. But when the Fed does announce, and if they do announce that, for instance, QE2 is done, I do think that the bubble will burst, and you don't want to be left holding the bag.
What do you do? Okay, I'll give you two scenarios right now, right, Keith? Let's say I'm a client.
Sure.
I call you up. I say, I got a bunch of stocks, 75, 80% in equities. Do I sell now in anticipation of QE2 ending, or do I buy more because QE3 could happen?
Well, it is short term. I'm actually looking for a market peak around mid-year. I happen to think earnings are peaking now through maybe the next quarter, and I think expectations are going to start to rise to the point where stock earnings actually can't meet expectations and they start being disappointments. At that point, I think the stock market starts to fall back. We've never had 3 years in a row of double-digit gains in the Dow, and this is not going to be the year where it makes that exception. I'm looking for a rally. I can see the market going up 10, 15, even 20% in the next few months. I'm bullish on the short term. However, I'm very fearful towards the second half of the year because much of the good news is already built in. QE2, QE3 is built in. Okay. As a client, based on your question, do you sell now? No. I think you stay invested. We are in a secular bear market, but it is a bull run in a secular bear market. We've never had two 10% corrections in a bear market, bull market rally within a bear market or any bull market. So what an investor might want to look at is really if we drop more than 2, 3, 4%, sort of a small correction, and we get a larger correction, I believe if we see a 10% or larger correction, that's going to grow to a 20 or even a 25 or 30% correction.
Keith Springer,
And
Springer
that's where you gotta be
Financial.
careful.
Keith, clear answers to a complicated question. Thank you multiple questions. Keith, thank you very much.
My pleasure, Brian. Thanks very much.
All right, take care.